Today I'm sitting with Professor Jackie Arendse, who's just presented on the budget for 2020-2021, and some interesting things came out of that budget conversation, which Jackie and I are going to maybe discuss and unpack a little bit. So for me, company tax was a big one, Jackie, that we talked about a possible change in the percentage on company tax, currently sitting at 28%, which from what you said is much higher than anywhere else in the world. Or maybe there are some that are higher, but it's a very high one. So can you give me a little detail on why they would drop it and what the implications are, and if they do drop it, where they're going to get the money from going forward?
It's a very interesting announcement to actually not so much saying the rate is going to change, but making the statement and almost creating the appetite and the expectation that company tax rates would probably come down in the next few years. So the statement from National Treasury is that they're working towards reducing company taxes in the next few years. Now, of course, to reduce the company tax rate, why would they do that? As you mentioned, our tax rate is higher than most other countries, especially our main trading partners. And we need to attract investment. Of course, we don't operate in isolation. So we have to have a company tax rate that is attractive for our potential investors. So to have a 28% tax rate is out of line at the moment and has been for the last few years. And so therefore, to attract investment and to keep investment in South Africa, the thinking is that we need to go for a lower tax rate. But in the current environment, with our budget deficit being as it is, pressure on tax collections and so on, it would be unrealistic to say we're going to reduce the company tax rate without some compensating factor to get more tax in from elsewhere. We need that tax collection at the end of the day. And the interesting announcement is that there's two main amendments that they're looking at with companies, and the one is to limit interest deductions, and the other one is to limit the set-off of assessed losses. And on the limitation of the interest deductions, National Treasury has released a very interesting document on their website. It's a discussion document at this stage, calling for public comment by the 17th of April. And what they're proposing is that really focusing on companies that are part of multinational groups, so South African subsidiaries of overseas companies, and this kind of multinational aspect, that interest deduction would be limited or capped at 30% of earnings, and the earnings they're talking about is basically earnings before interest, tax, depreciation, and amortization. So it's your taxable income before interest, before your capital allowances. So whatever amount that might be, your interest deduction would be capped at 30% of that. And then there's some thoughts about a sub-minimum amount. So for your smaller companies, if your interest is only, they're talking about 2 to 5 million rand a year, they would allow the full deduction, all other things being equal. But certainly for big deduction of interest with larger companies, that limitation could result in more tax being payable in the future. And then, of course, the other change is the limitation of assessed loss set-off. And that's especially companies, large and small, that have accumulated assessed losses that will take a few years to utilize, or maybe many years in some cases. So you set off your assessed loss against the taxable income in the next year, and currently you can set off the whole amount of the assessed loss, and you can keep setting off the balance of the assessed loss indefinitely. So this proposal is saying that you would only be able to set off an amount up to 80% of the taxable income for the year. So, for example, a company with taxable income of 10 million rand might have 50 million rand assessed loss, but they would only be able to set off 8 million rand assessed loss in that particular year, leaving them with a 2 million rand taxable income on which they would have to pay tax. Then, of course, 50 million assessed loss, we've utilized 8 against our taxable income, leaving 42 to carry forward. Of course, the question then is, are they going to put a time limit on the carry forward?
Well, I was really interested to find that out, Jackie, because, if it's indefinite, it would be interesting for companies who are buying assets all the time. They can continually push out that assessed loss, I assume.
And this is big practice at the moment. There are a number of companies with sizable assessed losses that don't really pay tax because of the assessed loss. And internationally, there are a number of countries that put a time limit in place. We've never had a time limit, and National Treasury is talking about a possible 5-year time limit. Whether that will materialize remains to be seen. We'll see the draft legislation on this coming out in sort of June, July, and that will give us a better sense of what they're looking at. But this will certainly affect the cash flow of companies that have these large assessed losses, because currently they're planning on no real tax liability until the assessed loss has been utilised. But this limitation creates what we could call an alternative minimum tax, that all companies would be paying at least a minimum amount of tax, even if they have these massive assessed losses.
I think that's a really interesting topic. I think it could have an impact on acquisitions going forward as well.
Yes, very much
so. Well,
yeah.
Thank you so much for that, Jackie. I think that's a really interesting evaluation of the current situation and something to think about as a company going forward.
Thank you.